Hi everyone, my name is Marcus. I am from Society General, from the cross-asset distribution team. So some of you might be wondering, what is SocGen got to do with, the Singapore market? What it's got to do with Hong Kong market per se? So just a very quick background, Society General is one of the leading structured products issuers, both in Hong Kong and in Singapore. We have been in the listed structured product space for over 25 years in Hong Kong. And in Singapore itself, we've launched a new structured product called Daily Leverage Certificates back in 2017. It's been 4 years since we listed it on SGX securities market. And since then, we have seen both the number of DLCs, Daily Leverage Certificates, DLCs, grown, as well as the trading activity of the DLCs. They have grown exponentially as investors look to DLCs as an efficient instrument to express their short-term trading activity, short-term view of both the Singapore and Hong Kong market. So therefore today, in today's very quick 30 to 45 minute session, I think I'll look at the Hong Kong stock market performance and how it has generally fared in January 2022, and some of the notable stocks we can see in the market, some top gainers, some top losers as well. And then thereafter, I would do a very quick introduction of this product called Daily Leverage Certificates, how it works, and why investors who are looking to gain exposure to the Hong Kong stock market should consider these DLCs, and also those who already have exposure to the Hong Kong market, and why is it even more important for you to consider DLCs as an important instrument as part of your overall portfolio. Okay, so I'll just jump right in. Just a disclaimer first, nothing herein should be considered as investment or financial advice or any form of recommendation, and information herein is for illustrative purposes only, and it's not indicated for future performances. Okay, so this is the disclaimer. And then we look into the Hong Kong stock market in January 2022. Okay, January has been a very exciting start and a good start to the year for the Hong Kong market, given that it was one of the worst, if not the worst performing market in 2021. The Hang Seng Index, which is the benchmark index for the Hong Kong stock market, was down minus 14% in 2021. That's while the STI was up 10% and S&P 500 was up 27%. This was largely due to the ongoing China property debt crisis and also the tech sector clampdown. Right. So in 2022, however, in the start of January, in this short 15 to 20 trading days, we have seen that the HSI has actually registered a January month-to-date gain of 6.7% as of last Friday. Okay, it has pulled back a bit today in today's market session. And so, right now it's just sitting above the 100-day moving average. But on last Friday, it closed just below its 25,000 point level. So there was a bit of scare in the start of the year, the first week of January, where the Hong Kong Hang Seng Index actually fell again, close to its November 2021 low of 22,665 points. But it sharply rebounded after that, over the following weeks to break the 20-day, 50-day, and just last week, the 100-day moving average over here, the red line over here. So there has been a very sharp rebound in the Hang Seng Index over the last few weeks. And currently today, as our market close, we're just sitting above its 100-day moving average, which is this red line over here. Okay, so let's hope that 100-day moving average holds. The 100-day moving average is at 24,600 points level. Okay, so that is for the Hang Seng Index, which is the benchmark index for the Hong Kong stock market. So you can say what caused this sharp rebound over here, right? It's definitely been a very exciting January for the Hong Kong stock market because of the flurry of news that came out. Of that, there were 3 major news that came out of China in January 2022 that gave the market a confidence boost, to stage this rebound over here from 23,000 level all the way to close to 25,000 level. Okay, so first is China's GDP was for fourth quarter was at 4%, and the full year growth was of 8.1%. Surprise to the upside. Therefore, this was a positive sign for the China and Hong Kong market. And then that's where we saw the start of the rebound. And coming out this week, we have China's PMI coming out this week. So do look out for that as well, another economic data. And the second reason for this rebound could be something that as China looks to sort of soften its landing of its property debt crisis, China drafted rules to let property developers access pre-sale funds in their escrow accounts, as part of their ongoing efforts to ease the severe cash crunch in the property sector. So that is ongoing right now, and I think China is trying as much as possible to manage that situation, and we are seeing signs that China is really committed to do more, and nothing is more committed. So in this third reason for this, why we saw a rebound in January, is the biggest news that came out of China is China's central bank pledge to use more monetary policy tools to spur the economy. So while the whole world, Fed is tightening their policy, their monetary policy, we see China beginning to ease their monetary policy. Okay, the first rate cut on 17 Jan this year was the first in almost 2 years that China had actually eased its monetary policy. And analysts are expecting more easing measures to come in the coming months. So you see whether it remains to be seen whether China can actually, prop up the market and also give that stability to the market using these policies that they have, while the whole world, is actually going down into a correction. I mean, we saw NASDAQ, we saw the US market side going into a free fall last week. So it remains to be seen whether China's policy measures, this easing of policy measures, can help to actually prop up the market while the US side is falling. Okay, so that is for the Hang Seng Index right now. You see we are sitting just above the 100-day moving average over here, this red line. And then, below that is its 50-day moving average, as well as the 20-day moving average over here near the 24,000 level. So we'll have to see whether, the Hang Seng Index can maintain above these levels for it to push higher. Okay, that is for the Hang Seng Index generally. Let's move on to look at some of the top gainers and losers in January as of last Friday. Okay, over here, I hope you guys can see the screen. Okay, so I think quite a few of the property stocks have actually run up in January because of the easing measures and the support that the government has lent to the property sector. So quite a lot of the top gainers, such as Colai as well as Longfor, have gained substantially in January. So I'll not cover them in this top gainers and top losers because I want to uncover what are the other sectors that are also moving over here. Right, so the first one I want to go to is actually the largest HSTECH constituent stock, right? The largest constituent stock in the Hang Seng Index is Tencent. And then there was quite a flurry of news late last year as well as early this year about Tencent powering its stake in some of its investments, right? So as the biggest news was, Tencent was decided to sell its investment position in numerous portfolio companies as the Chinese government continues to add pressure or to give pressure to the big tech firms. First was JD.com. So it went ex-date on X sort of distribution on 20th of January. That's when, Tencent divested its stake in JD.com. And also, the next up, they have said that they want to also buy its stake in C Limited, right? So Tencent, there's a lot of portfolio. I think I can't go into it here of mature companies in their portfolio. So we'll have to see, which other companies will Tencent be sort of divesting in the coming months. But that is something to look out for as well. So that is the largest stock in the Hang Seng Constituent Index. Tencent stock is up about 7% in January month to date. Today it lost a bit of gains, I think 1 or 2%. But so that will bring the overall month to date gains of around 5 to 7% for Tencent stock. So it did rebound together with the overall market. But a few other sectors that I think would be interesting to look at is Seng China. So Seng China, together with Galaxy Entertainment, some of the Macau casino stocks did have a good run up in January because the Macau government clarified many details on their planned amendments to the city's gaming law, right? So Seng China, Galaxy Entertainment, they were beaten down quite bad last year. Seng China was down minus 46% in 2021. But it has rebounded 19.8% month to date as of last Friday. So that was one of the top gainers within the Hang Seng Index constituents stocks. Seng China, so the casino stocks have had a bit of a run up in January. So that will be like Seng China, Galaxy, as well as quite a few other gaming stocks. And The second sector that we saw quite a nice run up was the financials. So I think across the globe, all the different markets, all the financial stocks ran up in the start of this year. We saw DBS, OCBC, UOB, all moving higher. DBS to record prices. UOB, I think it went up to record prices or close to. So all the bank stocks ran up in the start of the year due to the Fed rate tightening measures, rate hike sort of news. And I think that the insurance firms like Ping An Insurance, Bank of China, Hong Kong also ran up and made it to the top 5 gainers and losers, top 5 gainers in the Hang Seng Index constituent stock. So it's up both about 17%. Ping An was down minus 38% last year, so that's a bit of a reprise. It has rebounded quite a bit, and we'll see whether the financial sector, the financial stocks can maintain its momentum as we go to the Fed rate, sort of March timeline of reducing its QE in the US side. So that's the financial side. We saw a good run up in January this year. And I think on the other sector that I want to talk about also is the oil sector. So you see over here CNOOC, together with PetroChina. So these are some of the large cap oil stocks, in Hong Kong, China. And these oil stocks have had a good run up in January as well, as oil stocks prices continue to rise in this inflationary environment. CNOOC gained 15%, which is boosted by the firm's special dividend that was announced. And also they announced a share buyback plan. So, CNOOC did have an extra boost from the company specific factor, besides the overall oil sector sectoral boost for all the oil stocks, pushing it up to the top 5 gainers in this January month to date as of last Friday. So financials, oil, gaming, casino gaming stocks, all did very well in January month to date. So these are some sectors to look up for. And also, but now, moving on to the top losers, we saw that some of the losers, I think it's generally more on company specific or sector specific factors. So the Geely Automobile, it failed to hit its sales target, resulting in the fall of its share price. It was down minus 8.7% month to date in January. And then some of the electronic sectors, sort of stocks such as, AAC and Sunny Optical, the handset or the smartphone sector, electronic sector, has taken quite a hit in January month to date. AAC Technologies was down minus 14%, Sunny Optical was down minus 15%. These stocks, I think generally saw a bit of a sector weakness, which I will touch on a bit later on when I go through the Hang Seng Tech Index. Okay, so moving on to the Hang Seng Tech Index. The Hang Seng Tech Index also fared pretty well in January. It did rebound together with the Hang Seng Index from its lows, but I think the Hang Seng Index lagged the Hang Seng Tech Index did lag the Hang Seng Index. Generally, maybe the tech sector has quite a lot of sort of still negative sentiment and a lot of downward pressure from the ongoing regulatory clampdown by the Beijing government. So, the Hang Seng Tech Index was hit quite hard last year. It was down minus 30%, where it lost, a third of its value last year. And this year, at the start of the year, we got an even bigger scare than Hang Seng Index because the Hang Seng Tech Index went even lower than its November low, right? It went even lower. It hit a low of 5,231 points on 6 January this year, before rebounding sharply like the Hang Seng Index. And right now, it closed above its 20-day moving average, but it failed to break above its 50-day moving average. So I think right now today you will see that it retraced quite a bit as well. I think it gave up its January month-to-date gains. This was as of last Friday, plus 3.5%. But today the Hang Seng Tech Index was down another 3%. So right now it's probably about flat for January month-to-date. And it's sitting in between its 20-day moving average as well as its 50-day moving average. So it's squeezing over here within the 5,600 level and the 5,900 level. So whether it breaks above its 50-day moving average above 5,900 or breaks below 5,600 is 20-day moving average, I think we will see that in the coming days or a week to see which direction the Hang Seng Tech Index will take. Okay, so that's for the Hang Seng Index. It has shown quite a bit of weakness compared to the Hang Seng Index. Generally, I think it's the overall tech sector factor. The Nasdaq side, the tech sector in the big tech giants in the US have also shown a lot of weakness, and I think that definitely that has asserted some of the pressure on the Hong Kong China tech firms as well over here. So it remains to be seen also whether this PBOC's monetary easing can help to prop up the growth stocks story. Of many of the constituent stocks here in the Hang Seng Tech Index. So let's move on quickly to look at the top 5 gainers and losers for the Hang Seng Tech Index as of last Friday, January month to date. Okay, I think over here, I think the top gainers wise, you can see the top 5 here is Autohome. Autohome is the largest second-hand car trading platform in the country. So it reported quite impressive car sales figure, which helped to propel its share price up in January month to date. So it's up 24% January month to date as of last Friday. Although it did fall quite a bit in last year 2021, where it was down minus 45%. Okay, another stock we can see also in the top gainers is Kuaishou Technology. So this Kuaishou was up 22.6% in January month to date. So this one is a video streaming company. And I think one of the catalysts I think we saw in January was JP Morgan Securities initiated coverage of this Kuaishou Technology and an overweight rating, saying the company will enter a positive earnings revision cycle in the coming quarters that should boost its share price. Right, so I think that's positive news for Kuaishou Technology. Again, this stock has been hit very hard last year. It was down minus 77% in 2021. And so now it's back up, rebounded 22%. It's still considered quite, a downtrend. After all, it's been down for 77%. It's down 77% last year. So these are some of the stocks that have rebounded in the first month of 2022 so far. Okay, I think JD also, one of the large caps, I think those large cap China big tech giants, Alibaba, Tencent, JD, all saw a rebound. Also Meituan saw a rebound in this month of January. Although their gains were roughly around 5 to 10%. So I think JD was one of the leading in terms of almost 12% gain in January month to date versus the other big tech giants. So Alibaba, I think Alibaba was only up around about 6-7% in January month to date as of last Friday. But today, I think if you have watched the Hong Kong market, you have seen that Alibaba has lost most of its gains in January month to date compared to your likes of your Tencent. Tencent was still maintaining a 5% gain month to date. So I think there's still quite a bit of downward pressure on Alibaba. So let's see whether Alibaba can, gain some strength in that sense. Okay. So also back to what I was talking about the the smartphone sector. AAC Technologies, Sunny Optical. These stocks are down to about minus 15%. In January month to date. So these stocks had a bit of company catalysts, company-specific factors that have caused it to have the share price fall. BYD Electronic, another handset sort of electronic company as well, also saw its price drop by minus 10%. So I think it's generally due to the handset smartphone weakness, sector weakness, as sort of summarized by Jeffries over here. They cut Sunny Optical to a hold from a buy. After Sunny Optical's earnings report, saying that the stock currently offered no upside to investors as smartphone weakness is still underestimated. And AAC Technologies' share price fell also after the company said it expects its 2021 net profit to decline by approximately 12 to 16% year on year, due to special exchange gains, drop out of special exchange gains in 2020, and a cut in government subsidies in 2021. So generally, there was quite a bit of weakness in the smartphone, electronics, handset sector. So do look out for it as well to see how it progresses. I'm not so sure how it correlates with the Apple share price. It could be a one of the correlation factor that you can see between the smartphone developers, smartphone manufacturing companies, as well as some of these parts, smartphone parts manufacturers, Sunny Optical, BYD Electronic, etc. So do look out for it, for this sector. So that is some of the top gainers and top losers for the Hang Seng Index and Hang Seng Tech Index. Overall, I think we saw a bit of a rebound in January month to date. And then we saw some old economy sectors that have gained, such as your financials, your casino stocks, as well as your oil stocks. So I think the tech sector has quite a bit of catch up to play. And it remains to be seen whether the PBOC's monetary easing can help to prop up this sector as well, to maintain that growth story momentum. Okay, so this is next one. I just want to share a bit of this is a little exercise that I did, while doing this presentation. CNY is coming up, 1st February to 3rd February. So just wanted to just share a bit of the research that I've done, a bit of just not say research, but just a bit of a back testing or just looking at the past 5 years during the CNY festivities. How did it fare in terms of the three different indices here, the Hong Kong market, Hang Seng Index, Hang Seng China Enterprises Index, as well as the Hang Seng Tech Index. So as you can see over here, the past 5 years of historical data have been quite mixed in terms of performance, a lot of red, but also a lot of green. Last year we saw a rally before CNY over here, but post CNY it declined, right? It went negative for these three indices. I'm not saying that for this year, we've seen a positive so far. Whether it become negative after CNY, it's really mixed. You have to look at the past years. It is a mix of performances. But also you see over here, in 2018, it was down negative pre-CNY, but it turned positive after CNY over here. And, let's see, in some of these cases here in 2020 and 2019, 2020, it was down pre-CNY. And then it also was down largely in post-CNY over here. And in 2019, it was up pre-CNY, and then it was up further post-CNY. So this is just the 10 trading days pre and post-CNY holiday. Just an interesting sort of study that I wanted to find out for myself. How did, these three Hang Seng indices perform pre and post-CNY? And it turns out to be quite mixed, but you can see over here, there is quite a bit of volatility. So I think liquidity usually dries up going towards CNY holiday, and then when it comes back, there could be a bit of volatile movements in the Hong Kong and China markets. So it's something to be prepared for. Prepare for increased volatility before the holidays and also after the holidays. But I think right now in the Hong Kong market, you are already seeing quite a bit of volatility in this January month to date, right? So I just wanted to share also, speaking about volatility, my last slide on the Hong Kong stock market, I think volatility has been rising, together with that rebound in the Hang Seng indices. So far Hong Kong market has rallied, in the start of 2022, rebounded quite a bit, but it hasn't been a one-way up. Okay, it hasn't been a one-way up. We've seen quite a few days of pullbacks and volatility in the three Hang Seng indices that I've just mentioned just now. So volatility has been rising, as you can see here, the 30-day historical volatility of the Hang Seng Tech Index and the Hang Seng Index has been rising. The orange one is the Hang Seng Tech Index and the green one is the Hang Seng Index. So volatility has been rising, and you can definitely expect it to rise, pre and post CNY. So do watch, your investment, your portfolio, as well as your position sizing. There are still many risks to the market that we have to watch out for. For example, China's ongoing clampdown of the tech sector, that is not over yet. It's still ongoing, and we have to see how it develops. I think we have to always keep a watchful eye over that, and not don't go all in. Still look out for how the China regulation is going to play out for the tech sector. And one of the biggest things, China's property debt crisis. China is trying to administer sort of a soft landing, or they're trying to help out that sector. But it still remains to be seen how the crisis will play out, whether the slew of property easing measures they're trying to put in there, and as well as the monetary easing policy, it remains to be seen whether it can prop up the Hong Kong and China stock market, as well as the property sector in specific. And also more macro, the Omicron cases continue to test China's zero COVID policy. So you want to see how that turns out. And also the Fed tightening of the monetary policy. You can't underestimate, how much the Fed is going to be pulling out of the market, and how that can have ripple effect, not just to the US market, but to all markets around the world, the global markets, including China and Hong Kong, could feel that ripple effects as well. So definitely, I think volatility is going to be there even for the China and Hong Kong stock market, and you need to be prepared for it. So I think this is something that is definitely going to happen. It's going to be a volatile, but hopefully, it will end the year 2022 on a good note for the Hong Kong and China stock market. Okay, so volatility is important to watch out for, and important to how to manage your portfolio. And so this ends sort of my stock market sort of recap for January. We collaborate with Tiger Brokers, SocGen. We work with Tiger Brokers to do this regular sort of commentary, just to give you a bit of a flavor of how the stock market, particularly Hong Kong stock market, has been performing in the month. I'm sure all of you are quite aware of the Singapore stock market already. So therefore, we wanted to give a bit more color on how the Hong Kong stock market is doing, for you to be able to keep abreast of what's the latest happenings, notable stocks that are moving. And, so that's why I just want to thank also Tiger Brokers for inviting me here today. And before I go, I just want to share with you guys an introduction to our product, as I mentioned just now, the daily leverage certificates, because, in this kind of volatile environment, especially in the Hong Kong stock market, we wanted to, share with you this product, daily leverage certificates, DLCs, that can really help you to manage this volatility and as well as to capitalize on this volatility in the market. Okay, so I'll just take about 10-15 minutes here just to go through what, the DLCs is about. Okay, so these DLCs are listed and traded on HSTECH securities market. So you can trade it, through your regular stock brokerage account. You can trade it on Tiger Brokers account. They do offer these DLCs under the SG, Singapore sort of market. So you can look for these DLCs using a stock code, or you can just search Tencent, or Alibaba, or DBS. You can find these DLCs listed within your Tiger Brokers app. Okay, so these DLCs, how does it work, right? It works. It is a leveraged short-term trading instrument for you to express your view, your short-term view. So for those who are, want to, take a bit more of a speculative position in some of the Hong Kong stocks or Singapore stocks, you can do it using the DLCs, and those of you who, you have a large portfolio of investments, in Tencent stock or DBS stock, and you see that there's going to be a correction, you think there's going to be a correction in Tencent stock or DBS stock, you can utilize our daily short. So this is DLC, comes in both long and short. You can see here that there's both a long DLC as well as a short DLC. So you can use the short DLC to hedge your positions as well, if you think there could be a pending correction, short-term correction coming, to hedge your overall long investment portfolio. And this is a leverage instrument, as mentioned. So it comes in 5 times or 7 times leverage. 5 times leverage is for the single stock underlyings, and 7 times is for the index underlying. So right now it is we have over 240 DLCs listed on HSTECH securities market. So you might see it in some of your, broker screens or broker trading platform. It usually starts with the name Tencent, 5 times long SG, and then a few digits at the back. These are your daily leverage certificates, DLCs. Okay, it is linked to an underlying asset. That's why in the front of the name of the instrument, there's always like the underlying asset. If it's DBS, it'll be DBS 5 times long. If it's Tencent, it'll be Tencent 5 times short, for example. Okay, I'll show you some examples later. So it's always linked to an underlying asset. The 5 times is on the single stock, and 7 times is on the indices. And it's traded on SGX, as I mentioned. Like a stock, you can trade it through your regular stock brokerage account. You don't need to open a separate account. And I think that's really quite an easy thing for you guys, as long as you are SIP qualified. Okay. So SocGen, we are the product issuer as well as the designated market maker for these DLCs. So we are there to provide liquidity throughout the trading day, or throughout the day, for you to be able to buy and sell these DLCs. Okay, like I mentioned, we have over 240 DLCs over here listed already. We have expanded the shelf since 2017. We started with just 10 DLCs in 2017. And now we have increased it year on year, and all the way until now, we have 247 DLCs. And over 50, 60 underlying assets that you can choose from. We have it over the MSCI Singapore Index. You have DLCs over the Hang Seng Index, Hang Seng China Enterprises Index, and the Hang Seng Tech Index. We also have on all the major single stocks over here. So definitely we have DLCs 5 times long and short on Tencent, Alibaba, Meituan. We have it on your bank stocks, DBS, OCBC, UOB. So quite a wide range of underlying stocks for you to choose from. And all of them will be 5 times long and short DLCs tracking this single stock DLCs, single stock listed on Hong Kong and Singapore. Okay, so the DLCs are all listed in Singapore. Just to remind you again, it's listed on SGX securities market. But then it allows you to gain exposure to the Hong Kong stocks. And later I'll just share a bit more on why, I think that people who want to gain exposure to Hong Kong stocks should consider the DLCs instead of buying the underlying shares itself. Okay, some quick basic features. I think, some of you might be thinking, so how does DLC work, right? So DLCs, it gives you that 5 times leverage on a close-to-close basis. Every day you get that 5 times performance. Okay, so for example, over here, DBS is up by 2% from day 1 to day 2. So it increased from $25 to $25.50, 2%, right? So the 5 times long DBS DLC will be up by times 5, so that's 10%. It will be up by 10% on day 2, whereas the 5 times short DBS DLC will be down by 10%, right? So, but then if DBS instead was down by 2% on day 2, it fell 2% from $25 down, 2%, then you will see that the 5 times long DBS DLC will be down by 10%, and the 5 times short DBS will be up by 10%. Okay, so these DLCs, if you get the direction correct, you buy long DLC, the stock goes up, then you will make that 5 times gain. Okay, but if the stock instead goes down, then you will lose that 10% as well. So the losses are amplified as well as the gains, right? And so these DLCs, every day they give you that 5 times movement of the underlying stock's performance. Okay, so that's quite simple in terms of it's very linear. And a bit later, I'll also elaborate a bit more. It is not a structured warrant, it is not an option. But the only thing that's common between DLCs and structured warrants and options is that it's a leverage trading instrument. But otherwise, it is not an option, it is not a structured warrant. There is no optionality impact, there is no implied volatility, there is no Black-Scholes model, there is no time decay. That's not how DLCs are. I think we launched this product here on SGX securities market because we wanted something simpler, a simpler trading instrument, short-term trading leverage instrument for investors. Okay. So the DLCs are all priced between 20 cents to about $2. So you can see over here, the 10-cent long DLC DIHW is priced at around 150. Okay, that was some time back. Okay, so that was about 11 Jan. So this is priced at $1.50. So 10 cent stock price is around I guess it's quite high, around 460 Hong Kong dollars. So it's quite high, it's about 80 to 90 Singapore dollars. So this is actually allows you to gain exposure to the underlying stock at a fraction of its price. I think for Hong Kong, for 10 cent stock itself, the minimum investment sum for you to make is 8 to 10K Singapore dollars to gain exposure to 10 cent stock. Whereas this 10 cent DLC DIHW, you just need to put in, it's in lot size of 100 units. So technically you can easily just buy $150 worth of 10 cent DLC DIHW. But of course you won't buy $150 because you got to take into account, your brokerage fees and your commissions. Therefore you might want, but at least you can't trade it in multiples of $150 instead of having to put in one big lump sum of 8 to 10K if you want to buy the 10 cent stock. Right? So this is where, these are where the DLC price is priced around 20 cents to $1. Different DLCs on tracking the underlying stocks will have different price range. Some are at 20 cents, some at 50 cents, some at $1. This one's particularly 10 cent will be at $1.50. So over here you can see this is where the 5 times performance comes in. It is up on 11 Jan itself. I think this 10 cent stock was up by 1.5%. And so the 10 cent long DLC DIHW was up by close to that, right? Close to 5 times that, 10%. Okay, so that's where the 5 times movement comes in. on a close-to-close basis, every day, it will give you that 5 times performance, right? So if Tencent today at, say, 11 a.m. is trading at 460 Hong Kong dollars and it's up by 1.54%. So, this Tencent DLC, 5 times long DLC, DIHW, will be 5 times of that performance. It'll be up close to 10% from its previous close at around 11 a.m. as well. So at around 11 a.m., SocGen, as the designated market maker, will be placing our bid and offers. We will be there to place our bid offers 1.495 and 1.515 over there in the market for investors to buy and sell the DLCs. Okay, so that is roughly how you can see that 5 times movement every day on a close-to-close basis. Similarly, for the 5 times short Tencent DLC, it was down also, close to 5 times that of Tencent stock. So because Tencent went up, therefore the short DLC had declined in value. Okay, so you can use the long and the short DLCs to express your view. If you are bullish on the underlying stock, you would buy the 5 times long Tencent DLC. If you are bearish on the Tencent stock itself, you see a short-term correction, then you can utilize the 5 times short Tencent DLC to be able to gain when the underlying stock falls. Okay, so that's the flexibility of what the DLCs can give you. First, it can allow you to participate or gain exposure to the underlying stock Tencent at a fraction of its cost. You don't have to put in 8 to 10K inside there. You can just put in 1K or 2K inside there to gain that exposure to Tencent stock. And then you also are able to have the flexibility to go long or go short, to express your view, both bull and bear view of the Tencent underlying stock. Okay, so as mentioned just now, the DLCs is a short-term trading instrument. You can use it for a variety of users. We do see some of the investors using it for day trading. Some of these day traders, they like to capture intraday moves. And some of these Hong Kong stocks can be very volatile during a day. You can move 4 to 5% a day. And therefore, times 5 of that, that's 20% a day. So there is definitely a lot of movement on some of the stocks like Hong Kong stocks that, you can capture 20 to 30% gains in a day. But of course, you also have to get ready your risk appetite for in case there could be 20 to 30% losses as well if you got the direction wrong. Okay, so that's for day trading. Swing trading, if you're more of a swing trader, you want to anticipate that the underlying stock or index could go up in the coming days or in the coming weeks, then you can also use these DLCs for your swing trades. And also, if you have a large portfolio of investment, like I said just now, Tencent stock, and you think you want to hold for life the Tencent stocks, but you see a short-term correction in Tencent stock, you can use the DLCs to hedge your portfolio without having to sell your own Tencent investment portfolio. You can buy some of the Tencent short DLCs to be able to hedge your position. So here are some examples over here, the Meituan long 5 times DLC over here. So as mentioned just now, the name of the DLC itself is over here. The underlying stock is over here, Meituan. And then the leverage factor 5 times or 7 times will be here. And then the long or short will be next. And then SG stands for Society General. So we are the issuer. And then the expiry date here in year, month, date format. So most of the DLCs are long dated expiry. It has about a 1, 2 years or 3 year expiry. So you don't have to worry too much about expiry. It expires every day. It'll just give you that 5 times close to close basis all the way until up to expiry. Okay, so there is a long data expiry, so you don't have to worry too much about the expiry date. So in this example here, DZHW, the 5 times Meituan long, rose by 14.5%, when Meituan rose by close to 3% during the intraday. That's about an hour and a half trade only. And then, the DZH provided returns of 15%, while Meituan gained 3%. So that's where the 5 times performance comes in, right? The 5 times leverage performance. Swing trading, if you want to hold it for a bit of a longer period, you can see over here, UOB was up by 9% from 25th Feb to 30th April last year. Sorry, this is a bit of a dated example, but I think it serves its purpose to illustrate to you where the 5 times performance or even more can come in. So over here, the DDWW, the 5 times long UOB was up by 48% during the same period over here, if you want to consider a swing trade on the UOB DLC, getting exposure to the UOB stock. Okay, so that's for a swing trade. Just a word of caution here. These DLCs are short-term trading instruments, so please, you want to look at it in terms of intraday, a few days, or maybe 1 or 2 weeks. But please do not hold the DLCs for months at end. It is not a long-term buy and hold investment product. This is a short-term trading instrument for you to express your short-term trading view. Okay, and hedging as well. Also, Tencent was down 24% over here from 2nd July to 28th July last year. And so the DMIW, which is the 5 times short Tencent, DLC, was up 209%. Okay, I'll explain a bit later why it is not 5 times. You see over here, 24 times 5 is 120%, but the DMIW was up by 200%. That is due to the compounding effect, which I will just touch on later. Okay, so that's where you'll see that, this Tencent 5 times short DLC, DMIW, stock code. So DMIW is the stock code of the DLC. If you go to your Tiger Brokers platform, you search DMIW, you'll be able to see this Tencent DLC as well. You will pull out this Tencent DLC. You can see that it gained while the Tencent share price corrected. So that's how you can use the DLCs, the short DLCs, to hedge some of the correction or short-term correction as part of your overall portfolio of Tencent investment that you want to buy and hold forever, you won't want to sell. So you can use it to hedge your portfolio as well in the short term. Okay, so quickly on why I think, why the DLCs are an efficient instrument for you to gain access to the Hong Kong stock market. All the DLCs I mentioned, all the DLCs listed on HSTECH Securities Market are traded in SGD. So you therefore, you don't have to convert your currency, your SGD currency, to Hong Kong dollars to buy the underlying stock shares. You can just buy the DLC in SGD terms to be able to gain exposure to the Hong Kong stocks. So you don't have to, have the hassle of converting currency back and forth just to gain that, a few days or a few weeks of exposure to the underlying Hong Kong stocks. And it's tradable through your standard brokerage account, Tiger Brokers. If you trade stocks on Tiger Brokers on HSTECH Securities Market, you trade your DBS stocks on Tiger Brokers account, you'll be able to access also these DLCs in the same account. You don't have to open a separate account as long as you are SIP qualified. And as mentioned just now, the lot size is 100 certificates. So, if it's a $1 DLC, you can just trade in units of $100, and then you can, depend on your position sizing, you can buy 1,000 or 2,000 or 2,200 kind of thing. So you can be very flexible in terms of position sizing for the DLCs, as opposed to over here, the example you see here, if you want to buy 1 lot of Tencent DLCs, 100 lots is the minimum lot size for Tencent, times 460 Hong Kong dollars, that's about 8,000 Seng that you need to put in just to, gain exposure to Tencent stock. So for some people, it might be quite a lot to one time go inside into to gain exposure to Tencent. You're not able to sort of dollar cost average in. You're not able to put it into different batches, to different bullets to load into Tencent. So I think these DLCs do definitely give you that flexibility to gain exposure to some of the Hong Kong stocks in smaller amounts for your short-term view. Okay, so you buy as I mentioned just now, you buy the DLC for Tencent, DIHW. You only can you can gain exposure to Tencent in units of $150, right? So that's a very efficient use of your capital. Instead of having to lock in $8,000, into Tencent, you can just use this if you only want to do a short-term view of Tencent stock. So it's an efficient use of capital. And also because of that, lower capital, you will also be charged lower fees, right? Your broker commission fees will be lower because you're using less capital. And also, you also have lower exchange fees. For SGX, they recognize that, the DLCs are a short-term trading instrument. Therefore, the fees are 8 times cheaper than their stock fees. I think for you buy DBS stock is at 4 basis points. But for SGX to trade the DLCs is at 0.5 basis points. Okay, 0.05% over here. Versus if you trade the Hong Kong Stock Exchange, stock itself, you trade Tencent itself, it is at 0.13%. And of course, it's 0.13% on $8,000. So if you want to gain $8,000 of exposure on Tencent's stock itself, and you have a short-term view, you'll be better off just buying the $2,000 worth, about $1,000+ worth of Tencent long DLC to gain that $8,000 exposure, because times 5, right? So 1,500 times 5, 7,500. You will have gained the same exposure to Tencent stock and used less capital and also incur less fees when you use the 10-cent DLCs for your short-term trading. Okay, but some things to look out for when you are trading the DLCs to get exposure to Hong Kong stocks. Take note that there's no market making outside of Hong Kong exchange trading hours. So between 9:30 to 4:30 is 4 o'clock is Hong Kong trading hours. So for HSTECH, we open trading at 9 o'clock, right? 9 a.m. So 9 a.m. to 9:30 a.m. there is no market making. SocGen as the designated market maker, we will not provide any market making bid offers from 9 to 9:30 a.m. as well as from 4 to 5 p.m. Okay, so just take note of that. The underlying stock doesn't move means that the DLC, there'll be no market making on that. Okay, and also overnight risk, when some days where Hong Kong market is not open, but, overnight risk. And also some bit of the foreign exchange risk because of the underlying stock itself. And overnight costs and fees for the DLCs. So, these DLCs I again mentioned, it's not meant for you to hold for long term. Also, one of the attributing factors is because you are charged an overnight funding cost that is published on our SocGen DLC website every day. This is published every day. So if you're trading for a few days or a few weeks, the cost is not. The cost is, I would say, it's not substantial. But if you were to hold it for months and the overnight funding cost can be substantial. So you need to be careful that you do not buy and hold this product for months at end. You should also. But if you trade this product DLC intraday, take note that there is no cost and fee in charge except for your usual brokerage fees. Okay. So compounding effect, just very quickly, as I mentioned just now, there is a compounding effect which can work for you or against you. So it's best illustrated in the example over here. So in the strong trending market, the DLCs, the compounding effect, which is an important feature in the DLCs, can work for you to give you the extra kicker. Just now you saw that UOB was up by a 10-cent was down by 24%, but the DMIW was up by over more than 5 times performance, right? It's up by 200%. That's because of the compounding effect, right? Every day your gains and losses are locked in. Therefore, every day your gains is compounded on a daily basis to give you the extra kicker. So in this example here, over here, on day 1, day 2, and day 3, the underlying stock, whatever it is up by 1%, 2%, and 2%, right? On day 1, day 2, day 3. But the 5 times DLC, every day it gives you that 5 times performance, that times 5, 5%, times 5, 10%, times 5, 10%. So every day gives you that 5% 5 times performance on a day-to-day basis, on a coast-to-coast basis. Okay, but at the end of the day, it is up by 27%, even though the underlying stock is up by 5%. So times 5 over here is 25%, right? But the 5 times DLC is 27%. So where did the extra 2% come from? That is because of the compounding effect. Every day the gains are locked in, and so the 10% is based on a higher base, 10% is based on a higher base over here. So in a strong trending market, whether it's up or down, the compounding effect can work for you. But in a very volatile market, where this underlying stock is up by 2%, down by 4%, and up by 7.3% to give you that 5% gain again, right? At the end of the 3 days. But you will see that this 5 times DLC is up only by 20% instead of the 27% you saw here. And that's less than 5 times performance, because you can see over here of this sharp drop on the second day, it was down by 20%. And so the third day when it's up by 37%, it is based off a lower base. Okay, so the compounding effect can work for you or against you. So you got to have some conviction, in terms of whether you think it's a strong trending market or downtrending market. But also you got to see in the shorter term, you should not see such a big compounding effect, such a strong compounding effect. If you hold it for a few days or if you hold it for a week, it should not be such a strong compounding effect. But if you hold it for a longer period of time, the compounding effect can be very strong. And therefore, this product is really not designed for you to be a buy and hold product. It is meant for you to be to express your short-term trading view, whether it's intraday, a few days, or even a few weeks, but definitely not for months at end to hold this product. Okay, that's the compounding return. And I know this is very quick, just introduction. You can read more on our website, which I will show you later. Okay, so this product, I just want to do a quick comparison. DLC versus other leverage products out there. You can see over here, the DLCs are exchange traded instruments. Okay, so compared to CFDs, they are not OTC. So CFD is not listed on the exchange. So CFDs itself, they are margin products. You put in $2,000 and then you can margin up your $2,000 to get $10,000 exposure times 5 leverage exposure. Okay, whereas for the DLCs itself, it's not a margin product. If you put in $2,000, that's the most you can lose. You cannot lose more than $2,000, even if the stock goes sharply against you. The most is you lose everything, $2,000, but you will not lose more than that. But if you trade CFDs, there is the risk of a margin call. You can potentially lose more than that if the underlying, sort of goes sharply against you and you didn't put in a stop loss. You could possibly incur, a margin call, and you could lose more than your investment capital over here. Okay, and so another thing also about DLC versus CFDs is CFDs, their commissions is charged based on the full notional amount. So you put in $2,000, you trade up to $10,000 exposure to 10-cent stock. Your commission is charged on $10,000, whereas for DLCs, your commission is charged only on the $2,000 that you put in to gain that 5 times exposure to 10 cents, for example. So for an active trader who is in and out every day or intraday, commissions do build up and it matters a lot. So I think, if you are an active trader, you might want to consider DLCs as a more efficient tool to gain exposure to the underlying stock if you are an active trader. Okay, so that's we have this chart as well on our website. You can have a look at it furthermore. And I think our website is at dlc.socgen.com. Okay, so this is where you can find more information. So I think very quickly, I will just do a quick share of our website. So you can have a look at, in case you don't go to the wrong website. So this is our website over here, dlc.socgen.com. I hope you guys can see this home screen over here. So this home banner over here, we do have keep you updated on the latest news. Our new listings. We launched Ganfeng recently, and also Xpeng, the electric vehicle team, Bilibili and Costco shipping. And over here we have some banners on, we track which are the underlying stock that has the highest turnover in the last 5 trading days. And then we also show you which are the DLCs that you can express your view with. You can see the top gainers and losers here. You can create your own watch list as well. But let me just show you over here. You can go into the search page to search for which is your DLC that you want. So for example, you want to look at Alibaba. Okay, we have quite a few Alibaba listed over here. But just for ease of your trading, look out for the star ones. The star ones are the most sensitive DLCs, meaning that they move the most number of ticks in line with the underlying stock. Look out for the star one. So if you are long, if you want to go long on Alibaba, you think that is bullish on Alibaba, you can choose the DVIW stock over here. You can choose this Alibaba DLC over here, DVIW, or if you are bearish on the underlying stock, you can choose DAGW over here. Okay, and then you can also add them to your watch list by clicking on the plus button over here, and then you can see your watch list over here. Okay, so this watch list function, you can use it to add your preferred DLCs inside. But let me look inside here. Okay, so you can see over here, Alibaba was down 6% today. I mentioned just now that they lost, I think they lost most of their January month-to-date gains as of last Friday, but today, they lost most of the gains this year so far. And you can see over here, that's where the 5 times movement is, right? Alibaba is down by 6%. And so this DVIW long DLC is down by 30%. And correspondingly, you can see over here, the short DLC, DAGW, is up by also approximately 30%. So that's where the 5 times movement comes from over here. So yesterday, the DAGW closed at 1.793. And so today it's up to 1.81, which is a 33% gain. Oh, sorry, this is updated for today's close already. Okay, so you can see that 5 times movement over here, 6%, 30% gain. Okay, and for tomorrow, you want to see how Alibaba moves. We have this price matrix too for you to see. So this price matrix is an intraday price matrix for you to see how does the DLC move in line with the underlying stock, right? So today Alibaba closed at 119.1, right? $119. And then the DLC closed at 1.793. So tomorrow, if let's say Alibaba were to rebound back up to 5%, gain 5% tomorrow to 125.1 level, then you can see that the DLC would, it will go back, it will correct back to $1.34, down 25%. So that's where the 5 times performance is. If Alibaba continues to go down tomorrow by another 5% tomorrow to 113, then you can see that the DLC will be quoting at $2.25. That's a 25% gain from today's close as well. Okay, so this is how the DLCs work. and this is a live example. You can see over here. And if you want to look at the underlying stocks, there's a nice chart for you to look at as well. So this is some of the charts that I used in my slides earlier. You can do your annotation over here. You can draw your lines using the chart here. And the price feed is also real time, but it's not streaming. No website will be able to allow you to have the live streaming data for stocks. You just got to click the fresh, and then you'll get the live data snapshot of the Hong Kong Alibaba stock. And then you can see over here the list of long and short DLCs that you can choose from, and the star ones are the ones that are most sensitive to the underlying stock. Okay, so let's say you want to choose the AGW, right? You want to buy this stock, this DLC. So how do you go about it? You can't buy it here on this website. You just go to your Tiger Broker account or your other stockbroker account. You look for DAGW. This is the stock code. Search by the stock code, and you definitely get that instantly from there. And then you can place your buy or limit order, your buy or sell limit order, at where our bid and offer is. If you want to buy it at 180, you can place it in between this and wait for us to hit you in that sense. So this is how you would sort of trade the DLCs using your regular stock brokerage account. But you can use this SocGen website to see the prices. You can get all the information you need as well as the education information. Please, before you start trading DLCs, please also have a look, in this website. Go through our educational content, watch some videos over here to familiarize yourself with the key features of the DLCs, including the risks, before you start trading the DLCs. And if you have any questions at all, please just call us at our hotline over here, 6226-2828. My team and I, we are there to answer any of your questions. Please just call us, and we'll be happy to answer any of the questions that you have, as well as any sort of feedback that you have on the DLCs. You want to see this new underlying stock? Let us know. We can also issue a DLC on the underlying stock that you want. Okay, and also over here, this is a new feature that we just launched recently. You can see what are the top inflow and top outflows of the DLCs over here. So you can see who has been trading what, who has been trading the long UOB. I mean, so I think in today, last trading day itself, you saw quite people buying up the long UOB DLCs and the long Singtel DLCs. And also you can see a lot of people selling back or the short Thai BEV DLCs or the Kuaishou short DLCs over here. And you can see the historical trend over here. And also you can see Singapore stocks fund flow over here, right? This is something that we aggregated for you guys using the SGX market data. How has the fund flow been like over the last few weeks for some of the key stocks, and as well as the Hong Kong Stock Connect as well, right? So you can see which one has the largest flow, top 10 most traded stocks in the southbound Stock Connect. So you can use this data to get some insights, get some feel of how the market is, how the funds are flowing into which stocks and in which direction. So definitely we are providing you with more and more insights into the market for your trading needs. Okay. So there are a lot more tools and resources over here that you can have a look at, but I don't have much time to go in. It's been an hour. Time really flies. When I just going on and on and on about DLCs. But I really hope that today's session, has given you some insights, some recap of how the Hong Kong market has performed in January. It has been really an exciting month. And a lot of analysts are touting to say that, this year will be a great year for the Hong Kong China stocks. While the US corrects, the Hong Kong market will, rebound. But it remains to be seen how it will be like. As we only started in January, but it has been a very exciting start for the Hong Kong and China stock market already in January. And also, you can use the DLCs to ride on some of this volatility, whether is it a short-term uptrend or a short-term downtrend. You can use the long and short DLCs to express your view, and in a very efficient and a cost-efficient manner, and also an effective way for you to gain that leverage exposure. So again, if you have any questions, you can write to us, or you can also call us on the hotline if you have any questions about the DLCs. But I think that comes to an end for my session. And I want to thank Tiger Brokers for arranging this and inviting SocGen as just to share about the market. And I look forward to again, going through the market, Hong Kong stock market again with you in February, and hopefully we'll be able to see even more exciting trends in the next month. Thank you.